Coming up on a special edition of Market to Market. The worst drought in 50 years pushes grain and oilseed prices into record territory. And less corn for food, feed, and fuel creates ripple effects from Wall Street to Main Street. We'll examine the economic impact of drought with a panel of experts next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is a special edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. We're going to depart from our usual format on Market to Market this week to examine the rural impact of the worst drought in half a century. We've assembled an expert panel and we'll address some questions submitted from viewers this past week at the Market to Market website and through our social media channels, Twitter and Facebook. Joining me now are some of America's leading experts in key sectors of the rural economy. Iowa Secretary of Agriculture Bill Northey is a fourth-generation farmer from Spirit Lake who is in his second term as Iowa's top agriculture official. Creighton University economist Ernie Goss examines conditions in about a dozen states to compile his monthly Rural Main Street Index. Sue Martin is president of Ag and Investment Services in Webster City. Sorry, Sue, and has been a fixture on Market to Market for decades. And Jamie Kawaki, a relatively new addition to our stable of analysts. Jamie is branch manager for Paragon Investments in Topeka, Kansas. Folks, thanks for joining us on this special edition of Market to Market. Secretary Northey, I'd like to begin with you. You're a farmer and you're also Iowa's top ag official, so you travel the state quite a bit. What are you seeing out there on the ground as you travel around Iowa specifically?
Well, you know, it varies. Every place is hurt. Every place is hurt because of the dry weather and the heat. And I think it was as much the heat as it was the dry weather. But there's a lot of variation. So you have little spots where rain came through and that corn is still green. It's probably not going to be normal either, but it's a lot better than the worst spots. And as I hear all around the Midwest, we hear the same things, although there are certainly some areas that are mostly tough with very little good crop out there.
What kind of sentiment are you getting from farmers out in the field?
Well, they want to get into it. They want to see what's out there. They want to be able to move from 2012 to 2013 and forget this year.
Yeah.
Certainly the crop producers are very appreciative of having crop insurance. That lets them sleep at night. At the same token, they want to harvest grain. They're used to harvesting grain. They want corn and soybeans. Certainly livestock producers really want to make sure there's as much grain as possible, so we don't see this market go to another level yet. And those folks are very nervous as they're trying to make decisions about whether to shrink their herds or stay at the same size.
You bet. And I know elevators are looking for grain as well.
We are, and there's some concern about grain quality out there as well, and so that's on people's minds.
Sure, you bet. Now, Mr. Professor Goss, what do you see in your survey? What kind of responses are you getting back? What's the outlook looking like for this next 6 to 9 months?
You know, Mike, it's not original to me. I heard it's sort of like a flash drought. So it came up, I mean, our June survey results weren't bad. We surveyed bank CEOs in 10 states. Average community size is 1,300. And boy, the June numbers looked okay. July, not good. August, much worse. The bank CEOs are telling us, reporting for these rural areas, that things are looking tough out there. For example, agricultural equipment sales back to their recession levels, and that's, of course, not good. Farmland price growth it's coming down, but it's still positive. So that's not a bad signal. A lot of the bankers reported liquidation of herds, and for example, in June, 13% reported liquidation of herds, a significant liquidation. In August, it moved up to 50%. So you see that real change between June and August, and most of the changes were negative, very few positive changes in our survey.
All right, and now you've been conducting this survey since 2005, is that correct?
That's right.
How does the July and August numbers stack up against numbers in the past?
Well, look a lot like what we saw in the recession. That was back in 2008, early 2009, which were not good, of course. But there were some not so bad signals. For example, home sales were still good. Retail sales fell off the table, but of course we expected that with the drought. When you see things not looking so good, you pull back on your purchases. So we did see that. And of course, what people say, well, what about the future? Well, a lot to do with weather. I have a tough enough time with the economy, let alone delving in weather. So, but again, as one banker reported, he said, well, it feels a lot like the Dust Bowl, but I ain't moving to California. So, even though it's tough right now, it's better here than what we're seeing in other parts of the nation. We do a survey in California as well. It's still better here, even with this some negative numbers right now.
All right. Thanks, Ernie. Those trying to gauge the severity of this year's drought needn't look further than the markets. This week, however, mixed reports coming in from the Pro Farmer Crop Tour. Grain prices traded sideways. For the week, December wheat lost a nickel, while the nearby corn contract moved a penny higher. The real action this week was in the soybean pits, where prices soared to contract highs on Wednesday. Despite a pullback, the November contract settled Friday with a weekly gain of 85 cents, while nearby meal prices moved more than $17 higher. Sue, let's begin with you. The Pro Farmer Crop Tour this week revealed a few surprises, and yields are expected to be well below last year's. How much of an effect has that had on bean prices in this last week?
Well, it certainly did help, maybe with some realization. You know, soybeans are harder to tell as to what's really going to be there because they can fool you. But this year, we have to remember that, you know, you had heat and dryness moving in awful early. We were very dry in March and on through into June, and then July and August became quite aggressive, and August basically started to cool down a little bit and maybe give us a little chance of showers, although in some areas those showers weren't going to do anything. So the crop was stressed, and it was pushed ahead of normal, even though beans do tend to mature in daylight hours. It was pushed ahead, and blooms were aborted, pods were aborted, and so unfortunately the potting wasn't as aggressive as we would hope for. And the beans weren't as tall either, and you get out there and you look in the fields, they can be green, and then you get out in there and it's a real disappointment. And so everybody was kind of apprehensive, and we went in from the July highs where we were really hot into this cooler weather in August, and the market just started moving into what we would call basically an ascending triangle on the charts. And that is a very bullish chart formation. Also, wheat had, you know, not gravitating, just kind of, wheat did have a flag formation as well. And so all of those are bullish indicators, but still, it was a sign of uncertainty. Everybody was trying to assess the bean crop and didn't really know what to make of it. With the cooler temps, you didn't feel as hot, not as uncomfortable. You know, you basically thought maybe things could be a little better, and the market went in for a good, healthy correction. The market was very clean, and therefore, I believe soybeans, while they can still have another little correction here, of course, little could be 70, 80 cents, you know, in a heartbeat. But I think we're not done yet.
Okay.
The bean market's got much higher to go.
All right. Jamie, let's talk a little bit about wheat. The drought has intensified in several farm states this week, and the International Grains Council cut global coarse grain production estimates. What is your outlook for wheat prices?
Short term, I'm a little bit bearish wheat right now, looking for a little more downside. What the market's been moving off of pretty much is news out of Ukraine, Russia. Is Russia going to put an embargo back on or not? How small is the crop in the Ukraine FSU area? We're also seeing a little bit of dryness now down in Australia as well, but I think that'll be further in the fall until the market starts to play that if they have a drought or how small of a crop. The big key right now is pricing versus Baltic Sea. We're about $40, $45 a ton higher than wheat coming out of the Baltic Sea area. So I think we'll grind a little bit lower in here short term along with the other two grains and then crack back up higher later this fall. But until we get more competitive worldwide, I think the easiest path is just to see a little more profit taking.
Okay. All right. And what are you seeing in corn? We've talked beans and wheat. What are you thinking of
corn this week? Didn't see the technical fall through. Beans did. Beans raced to new highs. Like Sue was saying, corn never got through 849 December. That's the key point there to bust through. and hold. I think corn too, short term sideways to a little bit lower. There's not a whole lot of fresh news out there until the September crop report, so I think was waiting on yields, from producers come in. So I think profit taking would be the key. But I think long term there's more upside. We're going to be probably somewhere at 10.5, 10.3 crop. We're not doing a very good job of rationing yet. Ethanol numbers are good, export numbers are good, and I think longer term we'll be back higher than we are now, but short term looking for us to get back down below 8 and run some stops out.
All right. Sue, on corn, are your thoughts similar to Jamie's, or what do you
Yeah,
think?
they are. I think that the corn market priced itself out when it got to 8.50. And I think that it has the potential with rationing to come back higher and take a look at 8.50 again, possibly exceed it. But the problem is, and what we're telling our clients and subscribers is, from 8.50 to 9.20, follow that market and watch it very closely and use it for selling. Not to buy into it, but to use it for making sales. On the bean market, I think beans has to be your leader here. And that market isn't even close to rationing. And of course, if they do something with the renewable fuel standard, that just puts more pressure on soy meal. And you've got China, very avid buyer. They've bought 55,000 metric tons of soy oil this past week. Back in June, they had a pretty aggressive sale. And part of that sale they bought this week is for almost immediate delivery. It's old crop. And so I think that tells you their need. They're not having the best weather either, although they'll tell you every year that they've got a record crop. But it's still on the hook here as to just how high we can go. I think you're going to see $18.80 to $19.20 beans.
Would you be willing to put a time frame on that? How long term are you thinking, roughly? I don't mean to put you on the spot.
Well, to be honest with you, if we rally into October 4th, I take a good hard look at that.
Okay.
But whenever we get to that price level on the November contract, I don't want to be a game player anymore. I want to be out of it, and I want to sell the market. Now, I think you'll have higher highs again next year, but there's going to be a dandy little pullback somewhere in here to cleanse the market again and set the stage for next year's market. I don't think you're going to see South America plant beans early this year. They've got an issue with El Nino starting in, and the problem with that is that they'll be way too wet in the southeast, or the southernmost eastern parts of the country, and on into Argentina. In fact, Argentina, for the first time in 10 years, I think only one other time in 10 years in their winter have they had rain, and they've had 8 inches in August. I think that as we look at the bean market here going into the fall, we're going to get some more rally. But then I think you pull back. We watch South America, how well they plant, because the northwest part of that country tends to, in an El Nino, to become very dry. And that's over half of their beans. And so that is a major thing that we have to watch. If this is a typical El Nino, very weak at first, probably will be dry through September. But as you get into October and on forward, by the end of December, we should be in a very much more moderate, at least, El Nino. And that's going to have a big impact on them. What it does, though, is it keeps them from planting early. That extends our export window, which is very good for our farmers. But we're already, 55, maybe 56, 7% sold for what's estimated in the 2012-13 crop year. So I think we have to do some rationing.
All right. Now, Jamie, with that in mind, are you advising people to pursue any sort of option strategy? Is there anything out there that farmers should be doing to plan for the future?
I haven't here lately.
Okay.
Most producers are still trying to decipher how small their crop is and maybe oversold, not oversold. They're too scared to do any additional selling. They don't know how many bushels they have, so we're holding off.
Okay.
We will be making some additional sales here later this fall. I agree with Sue. I think there's more upside yet longer term. Any type of weather problems in South America, we're sharply higher.
All right.
Corn
But for
and
right
beans.
now, it's just wait and see what actually comes off the
Wait and
combine.
see. I think it's just going to be more of a technical flesh out. It's not a game changer where the highs are in for the year or next year's crop. There's still more upside to be seen, but just not healthy flesh out sometime this fall would be nice to start a next leg higher.
All right.
Mark, there's one thing, if we have time, there's the concern, and aflatoxin is becoming more and more in the news.
Yes.
And farmers need to realize, and the University of Illinois put out an article on the aflatoxin, very good article. And so I'm sure if they go on the website or something, they can find it. But the one thing farmers need to realize is they need to get their insurance adjusters out there before they even take that crop out of the field, because if they take it out of the field, take the chance, and it's refused at the elevator or whatever, and they put it in their bins, they have no protection on price. Their federal crop is no good.
Okay. All right, so definitely something to keep in mind.
Yeah.
And now, Secretary Northey, wanted to kind of come back to you a little bit. What is the Department of Agriculture doing in Iowa, or if you can speak to it, what do you know other departments of agriculture doing to help with livestock producers in this tough time? There's so much available for row crop producers.
Yeah, crop insurance is so important to row crop producers, and not everybody has it, but everybody had the chance, and,
Sure.
and they measured their risk and decided what they were going to do. Livestock producers are really suffering through this. The cattle feeders, others that need roughage, we're really short of roughage all over the country. There's been efforts to be able to free up any CRP ground, any state Department of Transportation along our highways, and Iowa even opened up some state land, that's some wildlife land. So there's a lot of effort to do that. In the Midwest, where there's corn, a lot of that forage is happening because people are chopping silage.
Right.
And so that helps get people through this shortage of hay that is needed through this winter. USDA has done a lot of work to try and free up some of that CRP land, even some wetland reserve land out there as well. So they've nibbled at those edges, done about what can be done.
Okay.
There's some things that could happen in a farm bill that would affect livestock producers, but mostly they're caught paying these kinds of high prices to feed the livestock that's out there and not getting any more for their livestock.
All right. And now, Ernie, I want to talk to you a little bit about ethanol and the renewable fuel standards. With ethanol consuming about 40% of production, what would changing or removing the renewable fuel standard, do you think that would have any effect?
I'm not sure it would, Mike. And we asked our bank CEOs last month, in June actually, what was the position of ethanol producers at that time? And we were talking about $8 corn, $8 and above corn. Of course, that puts pressure on ethanol producers. So they reported 66%, 2/3 of the ethanol producers had either cut back or closed temporarily. So right now you're seeing some pain out there among ethanol producers, but a lot of that depends, of course, on government policy and what happens. But right now, in my judgment, ethanol producers and a lot of the renewable fuels producers are getting to the point where it's sustainable. In other words, without necessarily government support. In some cases, the government is getting in the way, actually. And so, and a lot depends about, for example, the mandate of the ethanol mandate. I went to a legislative fiscal summit last week. No support for removing the mandate. All the legislators that I listened to said, nope, the mandate is going to remain in place. Of course, that's supportive of the ethanol industry right now in this window we're talking about. But overall, if you look nationwide, there's a heck of a lot of folks. Wall Street Journal, when the Wall Street Journal and New York Times agree on something, you got some problems. And their belief is there's too much support going for ethanol. I don't agree with that, but that's what they view it. And they're wanting to pull any support, whether it be the mandate or whatever, in terms of food for energy. There's a lot of I won't say lack of support for ethanol outside this part of the country.
Sure. Now, if looking at it from the other angle, if the mandate goes away, is that going to change the price of gas for consumers at all?
It's hard for me. I'm not certain. I don't know if I can answer that question. Sure. But in my judgment, at least, without knowing a lot more about the details, I don't think we're talking about big changes right now. I think, again, the industry is much more mature than it was 3 or 4 or 5 years ago. We're seeing sustainable growth. We're seeing And what happens, in my judgment, again, being on, is government policies, big changes there, and that's where the hurt comes. In other words, when you have certainty in federal policy or state policy, I think that's what the ethanol producers need. I think it's what the farmers need. It's what the states that we survey need. In other words, there's not some, it's just flip-flopping, and I'll call it flip-flopping in terms of federal policy, whether it's energy or farm policy.
All right. Well, let's go back to livestock a little bit. This market was mixed this week as October cattle lost 82 cents. Nearby feeders advanced by nearly $1, and the October lean hog contract declined 377. Sue, what are you seeing in the livestock industry for both cattle and hogs looking forward?
Well, I think that the cattle market, I think that once we get in towards October, the price is going to get a little better. It depends a lot on our winter. If we have an El Nino winter, the South tends to catch, more moisture, and then we tend to be maybe a little more open. And I think that could be something that also helps out the cattle market to create prices to push back higher. I think that demand has kind of picked back up here. You start to get past the hot days of summer that we've had, and demand, slacks off, and now we're starting to pick back up. I think that weights is the big thing, and I think they've peaked. I think that cattle weights have peaked. Hog weights, I'm not so sure. They should have peaked, but they're still up there too, pretty aggressive. And so I think that right now we've got more numbers than we need coming maybe to market for the cattle, but I think that's going to change. And as you start to catch some range through the south and southeast, we'll see cattle moving that direction. As far as the hog producer goes, I think he's in trouble. I think that the hog producer hasn't done enough yet to do liquidation. We basically have to shave 10% off of our feed demand. And it's in the livestock sector and poultry that you have to do it. And the cattle guy's gone through a bunch of it already by force and over the last 2 years. And so I think that it's the hog man and the poultry guy that's going to feel it. And they need to be pushing hogs and getting them to market. And there is going to be 140,000 kill this week on Saturday is expected. And that's, gosh, I think we haven't been over 100,000 since April. So that's good, but the weights are just too high. And also we have to worry about Japan. Their economy's slowing. China's economy's slowing. That's a concern. China's our third largest buyer. Japan's number one.
Sure. Jamie, now I want to talk to you about feeder cattle as well. As we go forward, and I know a lot of it's going to depend on the weather and what comes off the combine, what do you see in feeder prices in the next 3 months happening out there?
I'd be selling rallies here short term, like November, up around like 148.5. Seen a little bit of a bounce, a little bit of a correction, but I think corn still rebound after a little bit of technical fall through the downside, and cattle go back lower, the feeder cattle. But I would be selling $1.50 to $2 rally here in the next few weeks.
Okay. And then do you see that continuing on through next year? What do you see out there?
I see, the winter contracts, first quarter next year, live cattle, hogs firming up in here soon, and I think the tighter supplies will help out coming into next year with the meats.
All right. And now I want to talk to you guys too a little bit. Come up this week, and the QE3, quantitative easing, the third round of that. Ben Bernanke possibly putting that back on the table, and next Friday potentially being an announcement one way or the other. What are your thoughts? Jamie, I'm going to go to you first on this. What are your thoughts on quantitative easing? Would that have any effect if it's implemented?
I think probably have a little bit of effect. We saw some this week when the rumors came out. The dollar sold off really hard initially, and that supported the raw commodities. Silver is back above $30 an ounce again. Gold rallied hard. But I think by the time this would go into effect, it should be factored in. Be year end. The S&P's had over 10% rally this year, so I think a lot will be factored in. Spur some profit taking, probably late November, December time period. But it'll be bullish. The more rumors coming out next week out of Jackson Hole.
All right, and Ernie, do you agree with that?
I do, but I think also it's sort of like the third cup of coffee. The first one really it gives you a real jolt. The second one a little bit less. The third one, this is QE3, even less. And let's see what time it is, and we have to look at the time. The market's going back. Yes, QE3, no, QE3, yes. I think it's to a large degree overstated the impacts, and I think there's a lot of to be said for just staying put.
Okay.
In my judgment.
All right.
And if I were Ben Bernanke, I'd say no. That's
right.
You've got your last sugar high.
Now, Stu, that brings me to my next question. If Ben Bernanke follows Ernie's advice and next Friday comes out and says, nope, QE3 is off the table, would you see the lack of a QE3 having any effect? Would that lead to any softening in the markets, do you think?
I think it could just temporarily, but
Okay.
again, I think too, the blue moon effect, I think that it'll probably allow the market to step back, but I don't think it's a long-lived. I think we'll move back on. We're going to focus on the elections.
Okay.
Stock markets tend to rally in elections, especially with the Republican potential, and I think that that's what we're looking at more than anything. Our focus will just switch back to the elections.
All right. And Bill, what's your biggest concern heading into harvest?
Well, I think we certainly are nervous a little bit about grain quality and what happens, as well as how much corn there is out there and how many soybeans. I think there's a lot of nervousness around soybeans because they are so hard to predict. I mean, Pro Farmer counts pods, and you can tell a lot by counting pods. If they're not there, they're not going to be beans. But even inside those pods, the size of those beans matters a lot.
Right.
So I think we have a lot to see yet. We certainly could have some significant reactions based on that. And it's really more for the livestock producers. As I talk to many corn farmers, corn and soybean farmers, they say we're already down into crop insurance territory. They're able to sleep at night. They know kind of their bottom dollar, and they may be getting that from crop insurance more than the market. They may get it from the market more than crop insurance. But the livestock folks are the folks that are losing some sleep right now.
Yeah.
All right, guys, we've got about a minute left. Any final thoughts, Ernie?
Well, I think weather. And I've certainly, as I said, I have a tough enough time with the economy, weather. But if this continues, there can be some real hurt. But also the businesses, we need to be concerned about. The businesses are connected to agriculture, not just the agricultural sector, but the businesses.
All right, Jamie?
I'm just looking for a little bit of choppiness here in the grains, a little bit of profit taking, and a late year rally yet to be able to sell into.
All right, Sue?
I think that one of the concerns too is that agriculture's been the darling holding up exports for the U.S. And that's not going to be the case because if you don't have it, you can't export it. And the other thing is the quality of these soybeans is going to be really down. And that means you chew right through what we do have. It doesn't take long. You have to ration these prices, and the only way you do it is by shoving the price higher, not dropping it back.
All right, thanks. Bill, real quick?
Need some recharge in some of the soil out there as well. We've got some wells that are down, and certainly as we look towards 2013, we're going to need some water again.
All right, hope we get some rain. Folks, thanks for watching us. That wraps up this special edition of Market to Market, but if you'd like more information from Sue or Jamie on where these lofty markets may just be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us next week when we'll explain how a trio of brothers in Kansas is showing how they grow it. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.